This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In our first lecture on capital allowances, we learnt what it was that would qualify for those capital allowances. It wasn't just capital expenditure, it was a capital expenditure on qualifying plant and machinery. We then learned that the allowances available in relation to that were either AIA, WDA and or first year allowance there. What we're looking at now, having dealt with that first illustration at the end of our previous session, is a little summary of what we have seen so far, and then an introduction into, well, a term that we know, special rate pool. What we don't know is the particular expenditure that will qualify for it. Not that qualifying for it is a good thing. You will recall that special rate pool means 8% writing down allowance after any AIA has been claimed, whereas the main pool means 18% writing down allowance after any AIA had been claimed. Right, what are we told therefore here at the top of what is, let me just tell you what page that is, page 31 there, carrying on from where we left off last time. Right, as stated in section 3 above, new cars, low CO2 emissions, 100% first year allowance. What we'll have in any exam question is a list of additions, expenditure that has been incurred during the accounting period. And what we must do on the question page there is to identify which particular type of allowance will be available in relation to that, if indeed any. So if there's a new car, remember new cars with these low CO2 emissions, i.e. not exceeding 75 grams per kilometre there in terms of those emissions, we get 100% first year allowance. As we saw in section 2 of our notes so far, all plant and machinery with the exception of cars will qualify for AIA. With any excess expenditure over 200,000 per annum, AIA limit given on your rates and allowances page, £200,000, but that's based on a 12-month period. So if we had a short or long period, you'd have to time a portion net down, gross up, based on 200,000 for a 12-month period. Anything, as we've said there, over the 200,000 limit, we can't have AIA, so it's WDA. What we also get WDA on, cars then qualifying for writing down allowance at either 18% per annum if qualifying for the main pool, or 8% per annum if allocated as the special rate pool. Again, if we look back to what we were finishing with last time, we know that on our capital allowances rates information provided to us in the examination, we know what these various things are for cars. Now we've got there each of the levels of CO2 emissions and the specified allowance. Now what we have now been reminded of here is that in relation to expenditure that does not rank for AIA, because we've gone over the limit of 200,000, and thereafter also cars other than first year allowance low emission cars, it's writing down allowance. Depending on the exact level of CO2 emissions, either an 18% or 8% writing down allowance. What that means is that if it's 18%, such expenditure on cars will be allocated to the main pool, and if we're talking high CO2 emissions, then such expenditure on those cars will be allocated to the special rate pool. If expenditure qualifying for AIA exceeds the AIA limit, as we know, the AIA should be allocated firstly. Now here's something more interesting from a planning and practical application. If we've got expenditure in the year of £300,000, we've only got our AIA limit of 200,000. But that expenditure of 300 may be a mix of expenditure that qualifies for main pool and other expenditure that will be classified as special rate. So there's not enough AIA, 100% AIA, to go around to satisfy all of the £300,000. So where would you go first? Well, there's your answer. If our expenditure qualifying exceeds the AIA limit, the AIA should be allocated firstly to the special rate pool expenditure before the main pool expenditure. What is the reason for this? As any excess expenditure for the special rate pool would only attract 8% writing down allowance, whereas 18% would be available in the main pool. Better, therefore, to focus the AIA on your special rate pool expenditure, because anything left over that doesn't qualify for AIA would only attract an 8% annual writing down allowance. Whereas on your main pool items, anything left over will at least get an 18% writing down allowance, again on a per annum basis there. So what this means we have to now be able to do is to identify from a list of qualifying plant and machinery which of those would be special rate. For this we do, I'm afraid, have to learn, and hence section 4 here, what goes into that special rate pool as compared to all other qualifying plant and machinery that will be main pool. So here, not immediately, but again through practice and again continued study and learning, we have to identify what goes to the special rate pool. To begin with, we already know integral features of a building. Remember we said that if you were to buy a building is clearly not plant and machinery, and on that basis no capital allowances would be available. But in more recent years they have introduced the idea of integral features of a building. Now again, we know what they are. We had that list earlier, we spoke of it in our first lecture on capital allowances, but to remind you, things like lifts and escalators, electrical and general lighting systems, cold water, space or water heating systems, ventilation, air cooling, air conditioning, etc. there. All of these are integral features. So that part of the cost of the building, don't worry, if it were applicable, you will be told what are the integral features and what those specific costs are, then that would be special rate pool. It means if we're under 200,000 in total on all expenditure, great, we will get 100% allowance. But anything above that 100% AIA limit is going to only rank for 8% writing down allowance. What else goes into the so-called special rate pool? Next one we need to know, long life assets. So what do we mean by these long life assets? With an expected economic working life of 25 years or more, and that is when it was new. So when originally it was new, expected economic working life of 25 years or more. But although we may have such an item purchased within the period, you're told that this asset purchased has an estimated life of 30 years, or when new had an estimated life of 30 years. That therefore means more than 25 years or more there, and on that basis will be special rate pool expenditure. Now that will only attract this rule, this unfortunate rule of limiting the AIA, so limiting the WDA to the lower level of 8%, if, based on a 12-month accounting period, the amounts exceed £100,000. So if the amounts that you incurred were less than £100,000 within a 12-month period on such long life assets, then it's not special rate. So a question, a little planning issue could be that the business, you've been told, wants advice on the purchase of 2 specialised items of plant and machinery. These 2 items of specialised plant and machinery each have an estimated working life of 30 years from when new. That immediately tells you these are long life. And we're told that both of these items of plant, would individually cost £80,000. Now what that would mean is if we bought both of them within the same 12-month accounting period, the total expenditure, 2 times 80,000, would be 160. That therefore would be exceeding 100,000 and would be classified as a long life asset for special rate pool inclusion. Now even then it wouldn't be a problem, If that was only expenditure we incurred, we'd have our AIA limit of 200,000 available, so it wouldn't be a problem. But if this, on top of other expenditure, took us above, therefore, the 200,000, then it's an issue that we would have a restriction potentially in relation to the WDA if we went down that route. What could we suggest, therefore, subject to what is practical and what may be done within the business, is to buy those two items in separate periods. If we buy asset 1 this period, asset 2 next period, 80,000 less than the £100,000 limit, assuming both periods are at least 12 months there, and on that basis they are not long life assets. That means if any of the expenditure does not qualify for AIA, not a problem, you'll then get 18% writing down allowance. So integral features, the most likely one to see, probably the next most likely one, long life assets. Another one to be remembered, number 3 here, thermal insulation of a building. Again, it's a good thing. Things that are good things to do are rewarded within the taxation system. So here you do get capital allowances. The only problem, if we don't get in full AIA, it's going to end up as an 8% writing down allowance in the special rate pool. And finally, and we'll see this probably most regularly, motor cars with CO2 emissions over 130 grams per kilometre. Remember now that this expenditure, being on cars, does not qualify for AIA. With all the other ones listed, they would qualify for AIA. And if total expenditure came in within the AIA limit, we don't have a problem. But here, cars with the high CO2 emissions, there was never a case of AIA being available. The only thing we can have is writing down allowance, and that writing down allowance will be limited now within the special rate pool to just 8% writing down allowance. So, with a little bit of study, with lots of practice, we need to recognise those names of which assets will be allocated to the special rate pool. Then if we find, as we've seen in the note above, that the total expenditure eligible for AIA in your 12-month period exceeds £200,000, then we look at the mix of that and we would allocate AIA firstly to the expenditure that is special rate pool, hopefully less than 200,000, so we get 100% AIA and there's nothing then left to only get 8% writing down allowance on. It's then the main pool expenditure that takes you above the 200,000 limit, and on the rest of that, not qualifying for AIA, at least then you get the 18% writing down allowance. Okay. Again, practice, we said, is what we need. Oh, and as luck would have it, there, page 32, we have illustration 2 here to work our way through. Right. Now again, how we attack a problem like this in an exam question. We know that first of all that the capital allowances are being prepared for a 12-month period. The year ended 31st of March 17. Stephen prepares accounts to 31st of March. This time it's a continuing business. The written down value of the main pool, so our tax written down value, at the beginning of what was the year ended March 17, i.e. the 1st of April 16, is £40,000. So as you read through a question, we're trying to work out what columns will we need on the capital allowances computation and what allowances will be available in relation to the different items of expenditure incurred. We inherit a main pool, so that will be one column at least. You know that you'll always have on the far right-hand side of your page the allowances available column, and any expenditure that qualifies for either AIA or indeed FYA, we would include within a column on the left-hand side. You don't have to label it AIA stroke FYA, just a little pound sign will do, but a little column which we can list out the items purchased that would therefore attract that relief. What does then happen then during this period? On your question page, we would write purchase plant for £50,000. That therefore is AIA. Purchased a motor car here for £11,200 with CO2 emissions of 120 grams per kilometre. Right, motor car, it's not low emission, therefore what are the grams, the CO2 emissions, the grams per kilometre, and what pool does that put it in? Purchased a motor car, not low emission, so it's only a writing down allowance. It is between 76 grams and 130 grams per kilometre, so it's 18% writing down allowance, and it's allocated accordingly to the main pool. Whereas the motor car with 170 grams per kilometre will again attract only writing down allowance. It will be 8%, and it will be allocated to the special rate pool there. Whereas the low emission, 65 grams per kilometre, not exceeding 75 grams, that therefore will be your first year allowance, which you know to be 100%. So in relation now to the computation to prepare, before you put pen to paper listing out these items, dealing with the individual issues, what needs to go on our computation? Always on the far right hand side of the page, the allowances. We inherited a main pool. We discovered early on that there was expenditure that would qualify for AIA, so we would need the AIA column. We discovered later on that there was FYA expenditure that can be listed in this column as well. But we also discovered that the high emission car that we purchased would be allocated to the special rate pool. So before we start to list out the transactions of the period, let's get our computation sorted in terms of the columns that we need. That one, allowances, will always be required. Very likely AIA or possibly AIA stroke FYA. Very likely a main pool, possibly a special rate pool. Okay, now we can deal with the detail of the computation. Pick up of course, the opening tax written down value brought forward. That you're told on the main pool was £40,000. Obviously, you could have inherited a tax written down value brought forward on the other, the special rate pool, but you'll be told what those tax written down values are. What qualified as additions for AIA, the plant, 50,000, less than 200,000, full AIA available, and that goes into your allowances available column. It means that there's no residue of expenditure to go to the main pool there. We've had all of our allowances. There are two cars purchased that attract writing down allowance. So we now deal with the other additions that are eligible for WDA, and that will always mean at this part of the computation, we're talking about cars. Which ones? The 120 grams per kilometre, that one went to the main pool. 170 grams per kilometre, as we've identified up here, these were the two, that went to the main pool. Sorry, the 170, I beg your pardon, to the special rate pool. Once you've got your AIA, you've allocated in the additions of cars that attract WDA, we're then in the position to calculate the writing down allowance. So far as the main pool is concerned, at 18%. Calculate the allowance, transfer it into the allowances available column. Same with the special rate pool, only this time it's 8%. Calculate that figure on the balance within the pool at this point and transfer the figure across to the allowances column there. Those allowances that you've taken would therefore reduce the tax written down values to carry forward. But we haven't quite finished this computation because we did then have additions qualifying for 100% FYA. That was the low emission car, 100% FYA, which again means all of that expenditure goes into the allowances available column and there's no residue to go to either of the pools. FYA is 100%. Look therefore at what we've done. To begin with, you'll be given any tax written down values brought forward. We then list out additions qualifying for AIA. It wasn't here a problem, but if the total additions exceeded 200,000 and there was a mix of expenditure that qualified for main pool and special rate pool, we would give firstly that AIA on those additions that qualified, that had to be allocated to the special rate pool. Any residue, the balance, would then go to the main pool items. Having dealt with the additions qualifying for AIA, your other additions for WDA, i.e. your cars other than low emission. Where do they go? Is it main pool? Is it special rate pool? Again, dependent on the level of CO2 emissions. That information, again, remember, provided to you on your rates and allowances page. Once you've dealt with the WDA, additions then qualifying for FYA. So in this example, we've got examples of all three types of allowance that you may have to claim, whether it's AIA, whether it's WDA, whether it's FYA. Obviously there then at the end to tidy up what are the tax written down values to carry forward. So again, on your question page, you identify on the list of expenditure, as you see here, the allowances that will be available, allowing you to determine which columns you then need, structure your capital allowances computation in that way, remembering it's being prepared for the business's accounting period. Which transactions, after having firstly picked up the written down values brought forward, given in the question, which transactions first, additions qualifying for AIA, firstly special rate pool expenditure, secondly main pool expenditure. Then other additions that qualify for WDA, cars, which pool do they go into? Is it main, is it special rate, depending on the CO2 emissions. Calculate the available WDAs. Then, if you did have, as here, any low emission cars purchased, you would then be claiming your 100% first year allowance. Might want to spend time again, just have another look through that, make sure that you're happy with it and how we've approached the question. Otherwise, what we can then do is to move on to the next illustration, again involving both main and special rate pool. Okay, if we now move on together, therefore, and look at illustration 3. Kenny is our taxpayer, the trader, capital allowances computation for the year ended 31st of December 16. What are we told? Kenny prepares accounts, well as we know, to 31st of December. At the beginning of 2016, 1st of January, there's your tax written down value brought forward on the main pool, £22,000. That will be the starting point in terms of the capital allowances computation, and it means, of course, you need a main pool column. What then do we have? The additions during the period. Purchased machinery. That, therefore, will be AIA and will be main pool expenditure. Purchased a long life asset. Now remember, that terminology, that label, might not be applied. You may be told, purchased this particular asset. Note to it says, estimated working useful economic working life there, 30 years, and the expenditure being more than, you can see there it's 230, being more than 100,000, this is a long life asset. What does it mean? It means, fine, you get AIA, but that it's special rate pool expenditure. What you also now see is at 230,000, it by itself is bigger than the £200,000 AIA limit, let alone the fact that you've then got some AIA main pool expenditure. What do we know? We will allocate the AIA firstly to that special rate pool expenditure. More of that a little later. The final item purchased during the accounting period, a car, CO2 emissions 125 grams per kilometre. 125 between 76 and 130, so we're talking, as it's a car, not low emission, it's writing down allowance. What will that writing down allowance be? It will be 18%, and it will therefore be allocated to the main pool. So that analysis, using on a paper-based exam anyway, the question paper, and actually writing this information in as you read it through. As you read the question, you should effectively be answering the question. You don't have time in the exam room to just sit back, relax and read through and say, well, that was interesting. Now let's read it again and see what I've got to do. We look at the requirements, and then as we read through the question with those requirements in mind, we are able to make these notes on our computation. Just like in chapter 4, with adjustment of profits, you didn't read the content of the statement of the profit or loss account there. What you did on that statement of profit or loss, I should say, what you did was to, next to depreciation, you put a plus sign. Any other non-allowable expenses, you put a plus sign next to them. Any items credited that were not trading items, you put a minus sign next to them. Anything that was perfectly acceptable, put a 0 next to it there, and that would give you the basis for putting together your statement of adjusted profits. You use that question page on your first run through. So now, here with your capital allowances, use that question page, identifying what type of allowance would be available. So from that analysis, we have determined that as ever, we need our allowances column, that here there is an AIA column. There are no low emission cars purchased, so there's no FYA, but we will need this AIA column. We inherit a main pool, and we're buying a long life asset, a special rate pool asset, which is going to cost more than the AIA limit of 200,000, meaning there will be a residue to include within the special rate pool. Set up those columns, pick up your written down value brought forward, copied straight in from the question. Then, again, critically important, the order in which we deal with things. Additions qualifying for AIA. Firstly, the special rate pool expenditure, that was your long life asset there. The amount, 230, more than the limit of 200, so the 200,000 is available and goes into your allowances column with a residue of £30,000 to put into the special rate pool. Having now used all of your AIA limit, the other additions qualifying for AIA, so the first lot was special rate pool, this is main pool expenditure, the machinery for 45,000, no more AIA available, so the whole 45,000 goes to the main pool. It's joining there the written down value brought forward, and then other additions, cars, of course, that rank for WDA. The emissions with 125 grams per kilometre there, going as we've already said to the main pool. So there's another 8,000 to include. Add up the total as it is at the end of the period, take your 18% writing down allowance and transfer that across, of course, as we always do, to our capital allowances column in this computation. Special rate pool, 8%, take your figure, transfer across, work out the tax written down values carried forward if you have time. If you don't have time, leave it alone. Unlikely to be any marks for that. Again, just leave it having got what you do need to calculate, that figure, £215,900 worth of capital allowances. What would you do here in relation to Kenny's accounting period? You'd already have computed the adjusted, let's hope, trading profit of the period. You now know that from it, you can deduct this huge figure of capital allowances of £215,900. That would be deducted in coming to the tax adjusted trading profit or loss figure. The tax adjusted trading profit or loss figure there. Okay. Now, all the examples that we have seen so far, we've only had to deal with during the period. The purchases, the transactions we've had to deal with are just additions, purchases of items of plant and machinery there. What, of course, we are also likely to have to deal with is the sale of plant and machinery. And in dealing with the sale of the plant and machinery, there's a very simple rule. When plant and machinery is sold in the accounting period, the proceeds up to a maximum of the original cost of the asset is deducted from the balance of the unrelieved expenditure of the relevant pool. Now, we'll also need to see where on our pro forma we make that deduction. We deal, as we know, firstly with additions that qualify for AIA. We then have the other additions, the cars that only get WDA. And at that point, up until now, let's just have a look at what we were doing. At that point, we would then claim the writing down allowance. What will now happen is before that writing down allowance is claimed, either on main or special rate pool, it is in there that you would now be deducting in relation to disposals what goes in your sales proceeds to a maximum of original cost. Sales proceeds deducted to a maximum of original cost. Now again, in real life, it is very unlikely that you'd ever be selling an item of second-hand plant and machinery for more than you paid for it. So it's usually the proceeds. But be careful in exam questions, it happens on quite a regular basis. On one of the items, one of the assets sold during the period, you've managed somehow to sell it for more than original cost. So if you were told that you've now sold an item of plant and machinery for £10,000 and the original cost was £8,000, instead of deducting proceeds of 10, you'll deduct the original cost of £8,000. So we deduct proceeds to a maximum of original cost. Now at that point in time, we would recompute after disposals have been deducted here in terms of your main pool or special rate pool, take it out, and you would now have a residue on which you would claim your relevant writing down allowance. But if that residue is a low figure, then rather than taking just 8% or 18% of that low figure, we can take the whole lot. In section 6, the small pool's WDA claim is available to you. When is it available? What do I mean by a small figure? Where the tax written down value of either the main or the special rate pool prior to calculating the WDA, so after you've deducted disposals, prior to computing the WDA, if that figure for either of the two pools is less than £1,000, then the entire balance may be taken as a writing down allowance in that period. You don't have to take just this small amount of allowance. Remember, you work on a reducing balance basis. You don't have to pick away at these small numbers year after year at 18 or 8% on a reducing balance basis. Revenue again say, look, you're down to less than £1,000. If you wish, you can just elect to take all of it with a small pool's WDA claim. I've said it's £1,000. That figure is prorated if the accounting period is other than 12 months. 9-month period, 9/12 of 1,000. That therefore would be just £750 that you would be able to take. There's a little example that we have on this, example 1 here. Beth prepares accounts to the 5th of April. We've got to calculate her capital allowances for the year ended 5th of April 17. We're told at the start of this accounting period, which is the 6th of April, she's got a main pool balance of £1,250. She's purchased machinery of £10,000 in the period and sells an item of plant for £500 that had cost £3,000. Clearly, the proceeds are less than the cost. So in relation, therefore, to the calculations that we would need to do, a fairly simple exercise here in terms of the capital allowances computation that we need to put together. We're going to have just a main pool. We'll also need to know the allowances, and we're going to have our AIA column. What's the tax written down value brought forward at the start of the period? £1,250 there. Give myself a bit more room. What are the additions that qualify for AIA? That was, what do we call it there, purchase machinery. So we had a machine which cost £10,000. 10,000 AIA, 100% of course there, as it always is. £10,000, nothing to go to the pool, £10,000 in your allowances claim. No other acquisitions, so we take out disposals. Sales proceeds, as usual, less than original cost. From the main pool, 500 leaves us with £750. £750, less than 1,000, yet it's a full year end that we're dealing with here, so the £1,000 is the relevant figure, no need for it to be prorated. Therefore, what we'll be able to do is to make a small pool WDA claim for the entire £750 and take all of that as allowances this period. So rather having 18% on 750 and then 18% on the residue of that next year and smaller amounts, this could go on for years and years and years. HMRC don't want that. If a trader has to submit a capital allowances computation, then HMRC will check that computation. Here, just let them have it. So as long as we go below £1,000, small pool WDA claim is available. Okay, I think we've reached a suitable point now to bring this particular presentation to an end. And again, lots more, although the core issues you've now got, but there are a lot more issues that we need to have to deal with, and practice, of course, that will need to take place. So again, at least one more, if not two more sessions to go in relation to the completion of this chapter. But the core rules you now have. Before you progress to that next chapter, go back and ensure that you are happy with what we've seen so far about the structure of the capital allowances computation and about how then we put together those capital allowance computations and the claims that are available to us. Make sure you're up to speed before we move on to deal with some of the other smaller issues. Again, many of the things that we come on to deal with may not be involved within an exam question. The core stuff you now know, but often they are. So again, make sure you're comfortable with what we've done so far. Go back through the examples, and then I look forward to seeing you next time.